Well, hello there. Let me introduce you to Antoniette. She has recently gathered the right amount of money to start investing and has asked Marcos, Marcelo, and both Vitals to aid her. Antoniette's dream is to invest in a big company, a global one that was a consolidated player in the market and had a good reputation. But what Antoniette really wanted was to become filthy rich. Then, she found out that the first Coca-Cola company was founded in 1888 and began thinking about investing in it, since it had opened its capital in 1920. Coca-Cola Company is known to have acquired a wide array of companies in a number of different industries, just like Del Valle from the pre-made juice one. Also, Coca-Cola as a company has had considerable influence in pop culture. Hope and happiness, right? However, she found out that soft drink sales volumes had dropped by an 11% in 2017 alone, while sales of other products such as water increased by 10%. So, before signing her name on an investment paper, she wanted to find a little bit more about the company. But, just what the hell should she know? Well, first of all, what the company is like, what their financial ratios are, how their working capital is faring, how do they create money for shareholders, and finally, a risk-return analysis. So after digging up a little bit more on the Coca-Cola Company, she decided to move on to the ratios. But then again, what are ratios? Well, they're formulas that express how two or more aspects of a firm relate to each other. So, out of all of the different ratios, what are the most relevant ones to be analyzed? Well, they start with liquidity, or in other words, how fast can the company get their hands on their money? Then, profitability, or how much money does the company get and how do they get it? Then, there's leverage, or exactly how much of their capital is from creditors and how much is from other sources. Finally, debt, or how well is the company handling their debt profile. Now, starting with liquidity, the current ratio is a popular one, because it portrays the company's ability to pay its obligations. Its formula is current assets over current liabilities, so a current ratio of 1.02 in 2014 represents that the company had 2% more current assets than current liabilities. Coca-Cola started 2014 with a ratio well below that of PepsiCo, but it has been steadily growing throughout the years, and that is why in 2016 both ratios were the same. Now the quick ratio is just like the current one, except it doesn't allow for inventories, as it expresses one firm's ability to pay obligations without selling. Throughout the years, Coca-Cola's quick ratios have risen at 10%. Although that is good, PepsiCo has had a bigger average growth rate in the last 3 years period, which means that they are better equipped to deal with liabilities without having to rely on sales. The debt-to-equity ratio expresses the relationship between total liabilities and total shareholder equity. That is, in other words, just how many dollars of liability there are per shareholder dollar. Along the years, it is noticeable that Coke has been acquiring more capital from sources different than their shares. PepsiCo, on the other hand, has a comparatively high debt-to-equity ratio, which represents that it does not require as much shareholder investment as Coke. The return on invested capital relates total operating profits with total invested capital to show just how effectively a company has been using the money it receives. Coke's return on invested capital has decreased throughout the last 3 years, with the latest result being 14.36%. This means that the result achieved represents exactly the same percentage of the total investments. The free cash flow is a measure of the company's financial performance, calculated as operating cash flow minus capital expenditures. It represents the cash that a company is able to generate after spending the money required to maintain or expand its asset base. Free cash flows are interesting and all, but before we go to the numerical part of Coke's results, let's go to the second part of the video. Congratulations on reaching part 2 of the video. Now moving on. As I was saying, free cash flow is important because it allows a company to pursue opportunities that enhance shareholder value. Changes in it can indicate that the company increased or decreased its capability of fulfilling its responsibilities with their shareholders or even of investing in its operations. As can be seen by the last 3 years, Coke's free cash flows have declined a lot. This can happen mainly by two factors. Either Coca-Cola has invested in its operations or the capital available to pay investors has actually declined. To answer this question, we have to look at the EVA, which is the economic value added. It is a measure of a company's financial performance based on the residual wealth calculated by deducting its cost of capital from its operating. If the EVA is greater than or equal to 0, this means that the company has enough money to pay its creditors. So a decrease in free cash flow is not necessarily negative, as the company could be investing. However, observing the large falls in Coca's EVA and FCF, it can be concluded that the generation of shareholder value has actually decreased. The DuPont analysis is another good way of understanding a company's financials, as it basically breaks down the return on equity into its constituent components to determine which of these components is most responsible for changes in ROE. The first of the constituent components is the profit margin, which gives just how much of the total sales were converted into profits. In this sense, Coke's profit margin shows that 15.59% of all revenues became profit. The second of these points is the asset turnover ratio, which demonstrates just how effectively the company is using its assets to bring in money. In Coke's case, the asset turnover ratio is of 48%, which is understandable given its high fixed assets. The third and final component is the equity multiplier, which gives us the efficacy of the company in using its own capital to finance its assets. Multiply all three and then you get the return on equity. There is no point, however, analyzing each of the components individually. That is why we will look at their evolution through time. Analyzing Coke's DuPont equation, the growth in return on equity is noticeable throughout the 3 years. It can be explained by the increasing leverage, which we can see in the decreasing value of the equity multiplier. Because Coca-Cola has been dependent on leverage, it may carry a moderate degree of risk, since the bulk of its assets are financed through debt. However, even given the increase in financial leverage, the return on equity diminished in 2016. The operational profit margin is the greatest responsible for that, as the EBIT margins are declining. The EBIT decline is explained mainly because of Coca's revenue, that have steadily declined since 2014. Now, let's talk a little bit more about the cash conversion cycle. It measures how fast a company can convert cash in hand to inventory, accounts payable, and then back into cash. This reflects the effectiveness of the company's administration, and thus the firm's overall health. Its calculation involves three factors, which are the DSO, or Day of Sales Outstanding, DIO, or Days of Inventory Outstanding, and DPO, Days Payable Outstanding. The first of them, which is Day Sales Outstanding, is the number of days needed to collect on sales. As it involves accounts receivable, the only way to have a DSO of 0 is to promote cash-only sales. The smaller the number, the better. A DSO of 34 signifies that Coke takes a bit more than 1 month to collect all of the money from the sales and accounts receivable. The DIO is the number of days it takes to sell the entire inventory. As with the DSO, the smaller the better. A DIO of 62 means that Coke takes a little bit more than 2 months to sell their entire inventory. Finally, to calculate the cash conversion cycle after adding up the DSO and DIO, you have to subtract the DPO, which is Days Payable Outstanding, or the average number of days for payments or bills or accounts payables. To check out the conclusions about the cash conversion cycle, log into the next video. Welcome back. Now let's move on. In conclusion, a cash conversion cycle of 34 days means that is the amount of time Coke takes to convert cash into inventory and accounts payable and then back into cash through sales and accounts receivable. Along the years, Coke's cash conversion cycle has been steadily decreasing, by 5% in 2014 and by 25% in the last 2 years. This change was mainly due to an increase in day payables turnover, from 38 in 2013 to 62 in 2017, which implied improvement in managing their accounts. Now, let's pay a little bit more attention to Coke's stock and its position in the market. First, let's talk about Coke's beta. But what is the beta? Well, it's a measure of systematic risks, that is, of the volatility of a security in comparison with all of the market. The higher the R2 of the security in comparison to its benchmark, the higher the accuracy of the beta assessment. The value of 0.7 shows us that the Coca-Cola Company security is less volatile than the market, approximately by 30%. Now let's take a look at the risk rate. The risk-free rate of a security is the theoretical return of an investment with zero risk. That means that it is the rate of return of a period of time that investors would expect with absolutely no risks involved. The continuous decline of Coca-Cola risk-free rate means that there are more risks being associated with the company. Since macroeconomic indicators were good in the period, there is more chance that this movement is because of the company itself. Then, the equity risk premium is the excess return that investing in the stock market gives when compared to a risk-free rate, such as the US Treasury bonds. Then, the equity risk premium is the excess return that investing in the stock market gives when compared to a risk-free rate, such as the US Treasury bonds. This rate is based on the risk-reward trade-off view. Even if it had a huge growth from 2014 to 2015, we do not know if this means that the company is indeed stronger or had just generated more returns that year, which is noticeable in the decline from 2015 to 2016. Thirdly, the country risk premium is the risk linked to investing in an international company rather than a domestic one. Even if it is slowly increasing, the fact that the US is the safest country makes this rate the best in the market. And, at last, there is the expected market rate of return, which is based on investors' risk tolerance and investing style. It is calculated by subtracting the market risk from a risk-free rate investment. They vary widely because they're the reflex of what the market expects from the company's future performance. Finally, looking at the rate of return, you can see that it has grown from 2014 to 2015 and then from 2015 to 2016, which indicates that it has become more profitable to invest in Coca-Cola. So, after putting a lot of thought into all of the information presented, Antoniette decided to invest elsewhere. She picked as the two main reasons the overall decline of soda sales, as is already felt by the company's revenues. Also, she thought about the decreasing generation of value for shareholders, which only tends to decrease more with decreasing revenues. Thank you for watching our video, and goodbye!
Created using Powtoon.